Hello everyone. Today let's look at chapter 10. It talked about sole proprietorship, employer-employee payroll tax, and self-employment tax. About the business organization, they are divided into two types of business organizations. One is the owner is the taxpayer. For example, we have sole proprietorship, partnership, S corporation, limited liability companies. So for this business organization, the taxpayer is not the entity, but is the owner. Okay, for example, if you have your own business, you are a sole proprietorship, and the business is not the one who is responsible to pay the tax, but the owner of the business is the one who is responsible to pay for the tax. The second type of business organization is called corporation. Now, for corporations, the corporation itself is the one who responsible to pay for the tax. It's the taxpayer and also the shareholder. When the shareholder receives the dividend, it also has to pay for the tax. All right. So let's look at the first type of business organization that the owner is the taxpayer. We call it sole proprietorship. Okay. So for sole proprietorship, the business is owned by only one person. Okay, and profits and losses are reported on Schedule C. Okay, so I'll show you Schedule C. All right, this is called Schedule C class. So it's a part of Form 1040. You will have to fill this form when you submit it with forms 1040. So we call it Schedule C. So for Schedule C, we will have to write the name of proprietor, address, what kind of accounting method that you use, cash accrual or others. And then you have to report your sales revenue, minus any return and allowances. Then you get cost of goods sold, sales minus cost of goods sold, then you get gross profit. And here you will have to report all the expenses of your company, total expenses, and then that will give you the net profit and loss. All right. So Schedule C is to report the profit and loss from the business. That is for sole proprietorship. Now, if the business loss is greater than other sources of income, or in another word, you have more expenses than income, so in this case, you will have a net operating loss. And this net operating loss can be carried forward indefinitely. Okay. Now, let's talk about Section 199A deduction. So, do you remember when we calculate the individual income tax return? We have 4 steps. Remember that? Step number 1, calculate the total income. Step number 2, we minus above the line deduction, and that will give you a adjusted gross income. Okay, and then step number 3, we're going to minus the greater of itemized deduction or standard deduction. And step number 4, we're going to minus section 199A deduction. Remember, section 199A deduction means we can deduct 20% of your qualified business income earned by an individual through a sole proprietorship, partnership, or S corporation. It means we can deduct 20% of our qualified business income. Now, but there is some limitation of Section 199A. So the limitation is that it cannot exceed the greater of 50% of W2 wages or 25% of W2 wages plus 2.5% of unadjusted basis of qualified property. So it cannot exist the greater of one of these. Okay. Now, the question is, what is W2 wages? Okay, what is W2 wages? So normally the employer have to fill the W2 form. All right. Now that W2 form is a document that an employer is required to send to each employee and to the IRS at the end of the year. Okay, and the W2 will report the employee annual wages and amount of taxes withheld from their paycheck. Okay, a W2 employee is someone whose employer deduct taxes from their paychecks and submit this information to the government. So if you're working for some organization and they pay you salary and the company withholds some amount of your salary to pay the tax for the government, we call it as W2 wages. Okay, so it should not be more than 50% of your W2 wages or 25% of your W2 wages plus 2.5% of unadjusted basis of qualified property. So let's look at this example. Suppose that Miss W has a qualified business income of 1.2 million. She has W2 wages of 400,000 and her business owns depreciable tangible property with an adjusted basis of 900,000. Okay, so Miss W, did you see that? Miss W has a qualified business income 1.2 million. She has a wages of 400,000 and her business owns a depreciable tangible property with adjusted basis of 900,000. Okay, so how would we do that? Okay, so the section 199A deduction. Let's look at section 199A deduction. So she's supposed to deduct 20% of her qualified business income. So 20% times 1.2 million, and that will give you 240,000. Okay, and then the deduction limited to the greater of one is the 50% of her W2 wages. Her W2 wages is 400,000. So 50% times 400,000, that will give you 200,000. And then, or it is equal to 25% of W2 wages, 25% times 400,000 plus 900,000 times 2.5%, and that will give you 122,500. So between these two, 200,000 is greater. So instead of deduct 240,000, now we are limited to deduct only 200,000, the greater between this one. Okay? And also they say that qualified business generally excludes service businesses. It doesn't include business services and to be exempted from both the W2 wage limitation and the exclusion of service businesses for taxpayer whose taxable income before this deduction does not extend more than 315,000 or 157,500. What does it mean? It means that if you are married filing jointly and your taxable income is less than 315,000, then you will be exempted from the W-2 wage limitation above. Okay, you'll be exempted from this one and also from the service businesses. Okay, it means your business can be qualified as a business if you're under if your taxable income is under 315,000 or under 157,500 for others filing status. All right, let's look at example here. For example, I have Mr. K. He's a self-employed consultant with Schedule C profit of 330,000. The business pay no W-2 wages and has minimal property. Consider a service business. So if Mr. K is married filing jointly, okay, and her taxable income of 290,000. So her section 199A deduction will be 20% times 330,000, and that will be 20%. Okay, sorry, 330,000 times 20%, that will be 66,000. So her section 198A deduction will be 66,000. So it will not be limited because she earned less than 315,000 for married filing jointly. Okay, now let's look at the next one is the home office deduction. Okay, home office deduction. So home office deduction is for, if somebody use their home, a part of their home as the office, so they will be able to deduct a part of their expenses at their home for the business. For example, here it say a portion of the taxpayer's personal residence may be allowed as a Schedule C deduction if the office is used exclusively on a regular basis as the principal place of business operated by the homeowner, or a place to meet the patients, clients, and customers. So, for example, I use a room at my house, as the office to meet with my patients. So, in this case, I will be able to deduct a part of, my home expenses for the business. Okay, let's look at the example here. Mrs. G used one room of her home as a business office. The room represents 15% of her home's square footage. Okay, so this is the expenses for her home. She has to pay home mortgage interest, property taxes on resident, homeowner insurance, utility, housekeeping service, and repair. So the total will be 33,150. So because one room of her home is used for her office, and this is 15% of the home square footage. So she can deduct 15% of this total expenses. Okay, so it means she can deduct 4,973 as business expenses. And she also can claim a market depreciation uh, for her business based on 15% of the cost of the residence. So remember, if you use a room in your home for the office, you can deduct a part of your home expenses in your business expenses, okay, in Schedule C. All right, so that is for sole proprietorship.